Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, Senior Investment Specialist at iCM, and today I'll be joined by Mike Paciotti, iCM's Chief Investment Officer. Mike, thanks for joining us.
Glad to do it, Pete.
All right, so Mike, glad you're here. Let's take a look back at 2024. What were some surprises that you saw, both good and bad, from the markets over the course of the year?
So if we look back a year ago, there were actually quite a few surprises. I guess that's kind of the nature of short-term forecasts, which I lamented a year ago, and I'll go on that tangent again for a moment here. So there's quite a bit of randomness that occurs in the short term that usually gets washed out over longer periods, which is why, as you know, we don't rely heavily, or at all for that matter, on short-term predictions. So going back a year ago, we were expecting basically a decelerating economy, lower rates, but more importantly, a change in the shape of the yield curve to a positive slope and a broadly weaker dollar, right? That's probably not surprising because all of these things are related and they tend to go together. So in this environment, we expected short-term bonds and closed-end funds to do quite well. Short-term bonds did okay. There were times during the year as we rode the roller coaster of rates that we were very right in this call, and there were times that we were very wrong, and we probably ended somewhere in the middle with a decent outcome on short-term bonds on a very low-risk asset. Closed-end funds were actually nothing short of spectacular, gaining about 25% using the S Network index as the barometer. The real surprise to us was the continued strength of the U.S. equity market, which was expensive by every metric historically, and expensive to just about every other equity market across the globe going into 2024, but yet it gained another 33%.
Sure. So, how do you get a 30% gain from these levels?
It's kind of hard to do, but we've been doing it, right? So basically an otherwise expensive asset just got more expensive. So Here's kind of the breakdown. So year over year earnings per share increased about 10%, but we need to remove the cyclicality when we look at this. So we look at 10-year average real earnings per share, which increased by 4% over the last 12 months. A huge move when you consider that you're moving a 10-year average by 4% in just 1 year. So the dividend contributed about 1.5% and inflation about 2.6%. So the last piece is the change in valuation. So the Shiller PE began the year at 32 times the last 10-year earnings versus about 17 times historical, and ended at 38 times the last 10 years earnings, which is basically a 20% increase in the valuation multiple that was already wildly expensive. So the question that you pose is actually a good question, and it implies that this is ultimately unsustainable. But as we're learning, it can continue to defy odds in really short periods.
Do you think that was really driven by the strength of the overall economy?
I think in part it was. The rest of it is just really good old-fashioned animal spirits kind of running wild. So when you look at economic growth on the year, many, including us, were looking for a deceleration of the economy to occur in 2024 as the Fed pressed down hard to try to get inflation under control. Well, lo and behold, the economy grew at 2.5% in 2023, and it's going to grow another 2.6 or 2.7% in 2024. Some of it was real strength, right? Consumer spending increased by 3%, but some of it was a bit of election year magic as government spending increased by 3.4%. A bit of lily gilding maybe, but certainly not anything every incumbent party isn't really guilty of, but lily gilding nonetheless. So it still, to me at least, seems hardly worth a 30+% increase and an expansion of valuations by really nearly 20%.
All right, so let's keep valuations in mind for a second. How sustainable is the run-up in U.S. stocks, particularly on the large cap growth side?
Well, as I said a moment ago, eventually it isn't, right? But that's the dangerous part of bubbles, though, right? So there's an old saying by John Maynard Keynes about the market remaining irrational longer than you can remain solvent. And I think the warning here is really relevant and truly worthwhile, right? So you could be right eventually if you assume that the market will take a step back, but it's a painful journey getting there, right? Expensive markets, even bubbles, can and do get more expensive before they burst, right? We saw it during the tech bubble, and I think we're living it probably right now.
All right, so Mike, if you don't mind, let's drill down on that for just a second. Talk about what's happening, in U.S. markets, particularly by style.
So U.S. stocks, growth stocks in particular, are about as priced to perfection as you could get. So broadly speaking, markets are anticipating lower rates, but yet no damage to the economy, and earnings growth that is more reminiscent of recovery than a late innings bull market, right? So if we look at consensus analyst earning expectations, markets have priced in an 18% move higher in earnings by the year end 2025 versus a long-term historical average is probably closer to 5%. So that's a lot of optimism to live up to. And as we're seeing with NVIDIA the last few quarters, their numbers have been great, but not quite as great as everyone has expected. And when you trade at 50 times next year's earnings, you really need everything to be perfect or pretty darn close to it when you trade at that sky high of a valuation.
So do you see in this whole scenario, do you see parallels to the tech bubble?
Well, parallels are, I mean, it's hard to say parallels, right? In the tech bubble, we had a lot of bogus companies, right? Today, I think we have a handful of really wonderful businesses that have become the market, right? Some of them they're probably just not deserving of the market cap weight that they're getting or the valuation multiple that they're garnering.
Okay, fair. Now let's shift gears just a little bit. And, what's your outlook for 2025? What are you in the investment team really paying closest attention to?
So I still like closed-end funds, albeit much less than I did last year. I think with a yield of 5 or 6% plus some, modest discount narrowing and a small gain in the underlying assets, you could probably see your way clear to another double-digit year in closed-end funds. Now, short-term bonds on a risk-adjusted basis, probably not as good as last year, but with any kind of economic hardship, you can see your way again to mid-single digits type of year off of a very low volatility asset. Now, emerging markets value had a solid 2024, up double digits, but it's trading at a single digit PE, and it's probably one of the only truly cheap assets that are left out there. And I know everybody's concerned about Trump and China tariffs. That said, in 2017, the year after Trump took office the last time, emerging markets gained 37%. So I think I'll take my chances given really how dirt cheap the asset class is.
All right. So, I mean, is there anything that you're really excited about as we move forward in the new year?
So I'm looking forward to some of these imbalances correcting themselves, right? There's not a lot of fat pitches to swing at now. And the temptation is just to swing at okay pitches or to ride the hot dot, so to speak. So I think that spells trouble. So I'm really looking forward to an environment where my best advice isn't just be careful out there.
Fair point, Mike. Thank you as always. This is a great way to kick off the new year.
Glad to do it.
As always, if you have any questions, would like additional information, or have a suggestion for a topic for a future episode of Mic'd Up, please do reach out to us at 888-426-4689 or via email at info@icm-invest.com. And also, don't forget to check out iCM's YouTube channel for our newest content. Thanks for watching.